Okay, so the S&P is down 5% from all-time highs, and while I don't think there is enough information to say that right now we are in a stock market crash, I think we do have enough information to say that a stock market crash is coming sometime within the next year and a half. And so in this video, I want to break down some indicators that I use to tell whether or not a stock market is overvalued, and I'm also going to tell you how I'm going to be adjusting my portfolios in the coming months in order to prepare for a stock market crash. Okay, so we're going to look at a few indicators that we can use to tell if the stock market is overvalued. And so the first thing that I have for you is mergers and acquisitions activity. And so to understand why we look at this one, you have to really think about the reasons why firms engage in mergers and acquisition. Like, that's a pretty risky play, right? To buy a totally different company. And so we would only do this as a firm if we think that the demand in the future will continue to increase and that we can sustain that increase in demand by creating more products, usually through internal growth, or in this case, external growth, or mergers and acquisition. Another thing that firms will consider are the prices of these companies, whether it is a public company or a private company. And so firms generally don't want to pay high prices. Now, if you look at this, for example, 1999 mergers and acquisition peaked, and then it went down in 2000, 2001. We all know what happened. This was the dot-com bubble. People were crazy about companies at that time. Same thing, mergers and acquisitions peaked in 2007. And then in 2008, we all know what happened, right? The financial crisis happened. And so no one had any money to buy firms at that time. And so it seems that whenever we hit a peak, what follows is some kind of recession or crash. But we also notice that that's not absolute, right? So for example, 2015, we hit a peak. 2021, we hit a peak, and obviously we had then COVID, and now mergers and acquisition activities are going up again. And so we don't have enough information, in a sense. Well, we can look at it and get a sense of what happens, right? But we don't have enough information. Is this a downtrend, or are we a part of a new uptrend? We don't actually know. But what we do know is that mergers and acquisitions activities are down from all-time high. So there's a general downtrend that peaked. There's a general uptrend that peaked when COVID hit, and then from then on, we're still in a downtrend. Okay, and so that indicates to us that businesses are still not too confident about future demand for their goods and services. Okay, so let's look at another indicator. And so the next thing that we're going to look at is Berkshire Hathaway's cash positions. And so Warren Buffett is a pretty famous equity investor, and there's only really one reason why he would hold cash. It's because there isn't anything worth his attention in the markets right now to buy. And so if you look at his cash position, which is this blue line, it's sitting at over $330 billion. And that's the highest it's ever been. Okay? If we look at his cash position as a proportion to total assets, this red line, it's also the highest it's ever been in the last 10 years. So I can zoom out, right? And so he had really, really high cash positions. And then you'll notice what happens in these recessions is, for example, in the 2008 financial crisis, cash position went down, right? He found deals and he bought some. Same thing in 2000, right? He got into deals. Same thing in during COVID, right? So for the next year or two after COVID, he bought deals. And so you'll notice that when his cash positions are really high, it's just the reason is because he can't find any good deals. And so Berkshire Hathaway's cash position is quite high right now, and so that might indicate to us that the stock market is overvalued. Now, on the topic of Warren Buffett, there's also something called the Buffett indicator, and the Buffett indicator is the total U.S. stock market value divided by GDP. And so the thesis behind this is that the GDP, which represents the value of the goods and services that were produced within the economy, should have some relationship with the value of the companies that make those products and services. And so it turns out that the ratio historically has been really down during market crashes. And so, for example, you'll notice that during the market crash of the dot-com bubble, the Buffett indicator went down. During 2008, Buffett indicator went down. COVID, Buffett indicator went down. And what's interesting is this Buffett indicator has not gone above 2 standard deviations without crashing. Yeah. And so, for example, like this was the dot-com bubble. This was COVID. That's when it crashed. And then one thing you'll notice is there was also a crash in 2008, right? But in this situation, the stock market wasn't necessarily overvalued according to the Buffett indicator. So again, this is not absolutely conclusive, okay? And so there's another indicator that people use, and that is something called the CAPE ratio. So CAPE stands for cyclically adjusted price earnings ratio. So you know what the price earnings ratio is. It's the stock prices relative to the earnings of different companies. And so with this one, we get a much clearer picture. And so we again see that right now the stock market is quite overvalued, not as much as compared to the dot-com bubble, but it is overvalued, yeah? And so what we can establish, I think, is that compared to historical averages, the stock market is overvalued. But we cannot yet establish whether or not a crash is happening anytime soon. But there is one more indicator that may indicate a crash is happening soon, and that is the yield curve. And so one thing that you'll notice is if we take the 10-year Treasury constant maturity minus 2-year Treasury constant maturity, what that is the really a 10-year return on Treasuries and a 2-year return on Treasuries. Traditionally, we should be getting a higher return on long-term investments because we are more uncertain about what will happen in the long term, and so we should be rewarded for that. Yeah, but what ends up happening is sometimes the yield curve inverts. Yeah, and so when the yield curve inverts, what that indicates is the 10-year maturity is lower than the 2-year maturity, right? And so the 10-year return is lower than the 2-year return. And we might think, well, why is that the case? Well, it's because investors in treasuries are moving money away. And so you'll notice that if I just zoom out here to max, and even the last really 10 years, but let's look at max for a second. All of these gray areas are recessions, and it's interesting because it's all been followed by an inversion of the yield curve. Yeah, and so 1980s. More recently, the dot-com bubble, right? The yield curve inverted in 2000. 2008, right? The yield curve inverted in 2006, and it finished inverting around 2007, and we had a recession right after that. Even with COVID, the yield curve was near zero in 2019. And so what's interesting is the yield curve just finished inverting again. And so that could mean that there is a recession or a stock market crash coming within the next year or so. Okay? Another metric that you can look at is something called the leading economic index. Yeah? And so the leading economic index says here provides an early indication of significant turning points in the business cycle and where the economy is heading in the near term. And the coincident economic index provides an indication of the current state of the economy. And so what's interesting was that the LEI fell in January 2025, reverting most of the gains in November and December. And so if you look at this, the blue line is the leading economic index, okay? And so you'll notice that the leading economic index falls and starts to fall much earlier compared to when the stock market crash will happen, right? And so right now, the leading economic index has been falling literally for the last, 2 years, yeah? And that's interesting because that should indicate to us that the stock market is going to crash eventually, right? We don't know when, but it seems to us that sometime soon, right? Year and a half, something like that. You may be thinking, well, what makes up the leading economic index? Well, credit, right? Whether people are borrowing money, the stock market index, the interest rate spread, which is the yield curve that I just talked about, consumer expectations, new orders, private housing, average weekly hours spent on manufacturing, right? New orders for different kinds of goods, claims for unemployment insurance. And so all of these are indicators that, hey, the stock market and the economy might go into recession or a crash. And so there's no one indicator that we can use to say conclusively the stock market will definitely crash within this time period. But when we combine all of this information, I think one thing that we can establish is that the stock market is overvalued. Okay, so before I tell you how I'm shifting my portfolio to prepare for a stock market crash, I think one thing of note is your time horizon. And so if you have a time horizon of 20 years, 98% of people will not lose money if you invest in the S&P 500 over 20 years. And so I want to start by saying that I have a time horizon of over 20 years. And so I am not concerned really about a crash and my portfolio going to half of what it is, right? But what I am concerned with is whether or not I have the ability to buy the dip. And obviously I will not have the ability to buy the dip if I continue to invest every single month, all of my savings, all of my money that I save. Okay, and so another thing that we want to be careful of and think about is whether or not we are deviating from the plan. And so you should have a number in your mind, right? So for example, the number in my mind is, well, right now I'm 33. If I'm going to retire in 30 years at 63, I would want an inflation adjusted value of about $3.5 million. And I will be able to get there if I continue to invest $2,000 a month into the stock market for the foreseeable future, provided that right now I have around $100,000 in my portfolio, which I do. And so that's the plan I'm sticking to no matter what, right? Because that is the base case that I want to get to. But here's the thing. I have more than $100,000 in my portfolio. I have right now, because of the stock market gains that I've had over the past 2 years, I have around $200,000 in my portfolio, in my stock portfolio. And right now, I'm saving more than $2,000 a month and putting that towards the stock market. Okay, great. So what do I do? Okay, so if I'm gonna stick to the plan, which is I have 100K right now, and I'm investing $2,000 a month in a S&P 500 index fund, and that will get me to $3.5 million at 63 years old. Great, that's the plan I'm absolutely sticking to. And if I do a review of my portfolio right now, if you do a review of my portfolio right now, you'll find that I am overweight on the top companies, on the Magnificent Seven, if you will, on the NASDAQ and S&P. And we've just established that those companies are overvalued. How do we establish that? Well, we've established that the stock market is overvalued, and the stock market largely is driven by the top companies in that market. And so the 80-20 rule, right? And so maybe it makes sense to sell, and I guess it does. I'm making this decision as I talk to you in this video. Maybe it makes sense to sell a portion of my investments in those overweight companies, but definitely leave at least $100,000 invested, because that's what I want for the long-term growth. And then I will continue to contribute $2,000 a month to the portfolio in the form of a long-term, well-diversified ETF. But any extra money that I save above the $2,000, maybe it would make sense to hold cash so that if a stock market crash does come, I can buy the dip, because it will eventually come. And so that's probably what I'm going to do. Now, if you are in a later stage of your life and you don't have a 20-year time horizon like me, well, maybe it makes more sense to then switch to a more conservative portfolio that maybe has a little bit of gold in it. And you might be thinking, but Warren Buffett doesn't invest in gold. Well, Ray Dalio does, and the reason is because gold is an asset that is not that much correlated with the stock market. And so it will help you decrease volatility in your portfolio, which will prevent you from panic selling in case your stocks are down 30-40%, which can be scary if you know you're going to retire sometime soon. Another thing is making sure that you have enough either savings or insurance policies or bonds to sustain a lifestyle and not require you to draw down on your equity investments. Yeah, and so having enough money to live for like 3 to 5 years, even if the stock market crashes, because that's how much time it might take for the stocks to regain its value. Okay. Now, if you still want to maintain a higher percentage in equity investments throughout a stock market crash, but you want to decrease volatility, then maybe it makes sense to own more of an ETF like SCHD, which focuses on providing a dividend or an income for investors. Right now it's sitting at around 3%. Okay, and so that will help offset some of the volatility that come from a stock market crash, and you can use the dividends to live off of if that's something that you care for. Okay, and so to summarize, if you have a long time remaining before you retire, like 25 plus years or 20 plus years, well, stick to the plan. Don't panic sell. Stick to the set amount that you've decided to invest that will get you to your goal. But if you think you will experience a stock market crash in the near future, then we'll hold some cash. Hold some cash on the side, but don't sell everything. That's the worst thing to do, because you cannot be knowledgeable enough to time the market perfectly every single time, right? And so And so staying invested is a hedge against your own ignorance.